Okay, so can everyone see the slideshow?
Yeah.
Okay, great. Thank you for that confirmation. All right, let me grab my pen and we can take a peek at this. So the next, remember last time we were together, we looked very at more detail of the balance sheet, which are assets, liabilities, and owner's equity accounts. Unless it's a corporation, then it's assets, liabilities, and stockholders' equity, because we call owners of corporations stockholders. That's the only difference in the title. And then we also looked at a very important statement called the income statement, because the income statement is the only statement that can tell us whether we had a profit or not for the period of time that the business has been open. They measure that on a monthly basis. They measure it on a quarterly basis. They actually have to report on a quarterly basis if it's a public company. Now remember, a public corporation means anyone in the public can be a stockholder by buying a share of stock. So when you hear about companies on the stock exchange, they're all public companies, because you and I can be a stockholder in them by simply buying a share of stock in that company. So those companies are required to report every quarter. And then of course, they're also required to report annually. This particular statement here, the statement of cash flow, is a very specific statement dealing with what happened that period. In this case, this is the year. What happened that period in terms of where did they get their cash and where did the cash go? So cash flow statements look at specific uses and sources of cash for a company. And those come from three different types of activities: operating activities, investing activities, and financing activities really are the sources and uses of cash. Okay, so remember what a source of cash is how they get cash. And they can get cash by selling goods and services, right? And customers pay them in cash. So operating activities really revolve around when the business or the store is open. Operating activities are the same as opening, right? And when the store is open. Only when the store is open can you buy stuff. When the store is closed, it's not operating. You cannot buy anything, right? So customers will deal with businesses during operating activities. Some businesses operate 24/7, right? I mean, Amazon is always open. So they have continuous operating activities 24/7. Okay. And so operating activities include cash collected from customers that contribute to its net income or profit, plus all the ways it either saves or uses cash in its operating. An investing activity really involves around how the company uses its cash to buy more assets. That's what I look at. That's the main focus for me when I look at a cash flow statement. Is the company using cash to buy more assets? And that's very important, because if a company is purchasing more assets, that might be putting up more stores, for example. Well, that's a good activity, because more stores mean more sales of its goods or services, and that means more revenue and more profits. Companies can also use cash to buy things like investments of other sorts. They can also sell investments to get cash. Now, it's interesting that they show these negative numbers here, really not negative. They actually just show the use of cash. So when a company buys equipment, it's going to use cash. So cash is going to be used up. When a company buys investments, cash is going to be used up to buy those investments. But when they actually sell investments, cash is coming in. When you sell something, you're getting the cash. And so that's basically what these numbers mean. You don't have to really know many details about it, but you should know what an operating activity is, and you should know what an investing activity is. A financing activity is where the companies get money to buy those assets. And usually they're from two types of activities. One is they borrow money. So any type of debt is going to be a financing activity for the company. They also can get money from stockholders. And so when stockholders put money into the company, that's also a financing activity. But also when they pay debt, when they pay down debt, that's a financing activity. And when they pay dividends to owners, that's also a finance activity. So finance activities really have to do with any activities related to liabilities and owners or stockholders' equity, because that's how the company is financed. That's where they get their money. Remember, the word financing is commonly used. You'll often hear when you buy something very large, like a car, they're going to say, well, how are you financing this? In other words, where are you getting the money to buy the car? Well, you could have some money already saved up. That's your equity piece. But you also might need to borrow money, right, from a bank to purchase your car. And so that's the liability piece. So financing really is about where are you getting money to buy something large. You probably had that question with college, right? You have college tuition bill that's relatively large. How are you financing that? Well, some people are paying some portion of cash down on that. Some people are relying on student loans. Loans are liabilities, and the money that you already have that you put in would be your equity. So those are financing activities. So you should know what an operating activity, an investing activity, and a financing activity is in general for this chapter. Basically, again, all of this measures cash. Where did the company get cash? So that's a source of cash. And how did they use the cash, or a use of cash? That's all the cash flow statement tells us. So here they had cash at the beginning of the year of $35,000. All of these activities provided more cash for the company of $23,000. So now they have, at the end of the year, $59,000 of cash. That's really all a cash flow statement will tell us about. Okay, and I've already gone over this with you. Again, you should know what an operating activity is in general, an investing activity in general, and a finance activity is in general. Okay, and the last piece of this chapter talks about financial ratios. And ratios are basically, right, a comparison of two numbers, or a relationship between two numbers that give us an idea of, in this case, the health of the company. Ratios are used commonly everywhere when you're analyzing things. So for example, when you go to the doctor's office, which I'll be doing soon, they're going to be looking at a various amount of ratios, right? Maybe your weight to height, so your body mass ratio. They're going to look at the ratio in your blood pressure, right? Systolic and diastolic ratio. They're going to look, if they take blood work, they're going to look at your cholesterol ratios, good cholesterol and bad cholesterol ratios. Ratios are used to analyze things. So the doctor uses ratios to analyze your health. And in accounting and finance, we use ratios to analyze the financial health of a company. Okay. Again, one particular ratio might not tell everything. But when you look at a whole bunch of different ratios, they tell a story of the health of the company. Okay. So one of the things that a company wants to find out is, are they, what's their profit margin, right? What's their profit margin? We also call that a return on sales. Okay. And basically speaking, if you sell merchandise after you pay all of your expenses, what's left for you in the terms of a net income or net profit? And that's basically all this is saying. So for Northeast Art Supply, they made a $30,000 profit on $451,000 of sales. So they sold $451,000 worth of stuff. After they paid all of their expenses, what was left for them was $30,000. So that means that they have a 6.7% return on sales, or a profit margin, right? For every dollar they collected from the customer, roughly 6 to 7% of that, almost 7 cents of that dollar, is going to be their profit after they pay all of their expenses. So And this is important. I mean, Walmart sells tons of stuff. It's the biggest retailer we have, but their profit margin is actually closer to 3%. So think about that. For every dollar they're collecting in sales from customers, 97 cents of that dollar is covering their expenses. Only 3 cents is left for their profit out of each dollar. Of course, they sell over a half a trillion dollars worth of stuff. So that's a lot of pennies adding up per dollar. But this tells us basically over time, how is the profitability of the company? I will tell you, I will share with you as well that Apple has a very high profit margin. They're roughly about 20%. So that means for every dollar Apple is collecting, 20% of that dollar roughly is going to be their profit at the end of that period, which means 80% of your dollar that Apple is collecting is going to pay all the expenses. They're keeping about 20 cents on every dollar. And of course, on an iPhone that you're forking out $1,000 for, that's a couple of $100 profit per iPhone. Never mind the MacBook, never mind other things that they sell. It's a very, very high profit margin that Apple has, which makes them successful. Another ratio that we want to know about is, can the company pay its debts, pay its bills? And so we look at something called, and it's a very popular ratio, called the current ratio. And it looks at the company's current assets, the amount of assets that are cash or can be turned into cash quickly. And we compare that with the amount of current bills they have to pay this year. All right. And so here for Northeast Art Supply, company that's in your book, they have $182,000 of current assets. So this is cash plus assets that are going to be turned into cash within the year. And when you compare that with $70,000 of current liabilities, this is the amount of debts that they owe this year. The ratio is 2.6. Now, what does that mean? That means they have $2.60 of current assets for every dollar that they owe in current debt. And so this company is in excellent shape. They have more than twice as much current assets to cover their current bills. And that's a very, very good thing for a company. Some companies just aren't as fortunate to have such a high current ratio. And it's important because you need cash to pay your current debt, right? When a bill is due this month, you need cash to pay that bill. So having enough current assets to cover your bills is very important. And so that's why the current ratio is very important. And lastly, for a lot of companies who deal with inventory. Now, inventory is dealt with in retail stores. So how a retail store works, and I'll just use Walmart since everyone's probably been there. When you walk into a store like Walmart, all you see on the shelves are tons of goods, right? Walmart had to buy all of that and put it on the shelf first before they sell it to you. So that is what inventory is, okay? All of those goods that are on the shelf that the company has purchased for the purpose of reselling it to you. And that's inventory. So how you manage inventory is important. Don't you hate going into a store and they don't have what they advertise that they have? I don't know how many times that has happened to you, but sometimes they'll have something posted for sale at a very, very good price. You walk in the store and they don't have any more of that stuff. That's poor inventory management. Or just the opposite, they buy a whole bunch of stuff for sale and it doesn't sell. So that inventory is going to be moved over to clearance because they just want to get rid of it. They made a mistake. They bought it and no one bought it from them. So now they need to get rid of that. So one measure of how well a retail company is doing, because all retail companies do is sell inventory, how quickly are they selling their inventory? You know, because no company wants to have inventory on the shelf for very long. That inventory they want that inventory to be sold to the customer and for cash. I mean, that's basically when you go into Walmart, you buy stuff, they're collecting our cash, whether you're paying debit, credit, whatever. They're still collecting cash. You might get a bill from your credit card company, but Walmart's not getting that bill. Walmart's getting the cash. Okay, so all they care about is selling their inventory and collecting cash. So the inventory turnover rate tells us how quickly they're doing that. Okay, so for Northeast Air Supply, they are basically selling, they've sold $334,000 worth of inventory that year, and they have $40,000 of inventory in the store. So basically speaking, they have sold their inventory 8 times per year, okay? 8 times per year is a very rapid pace to sell inventory. It's usually a very good thing. Normally, stores that have very low prices tend to have very high inventory turnover rates because they're always restocking their shelves. And so this basically tells us that once they put a product on the shelf, it's going to be bought by the customer roughly 8 times that year. So they're always putting new products on the shelf because the inventory is always turning over a turnover rate. So that basically is what your book talks about here. I'm going to stop this and bring us back. It's just sort of an introduction to some financial ratios that help us analyze how a company is doing. And that's basically all financial ratios are really about. So again, this particular chapter introduced you to accounting information. I can't reiterate how important the income statement and the balance sheet are. You should really know those statements very well and the accounts on those statements, what they mean. And you've been introduced to a cash flow statement, which just looks at how companies get cash and how they use cash. That's basically all the cash flow statement tells us about. They use it in the general operating activities, right? It's the general opening and closing of the business. They're going to be using cash and getting cash. They use it when they do investing activities. So when they buy more assets, those would be investing activities. And where they get the money to buy everything is a financing activity. So where do you get money? You either have it, which is equity, or you borrow it, which is liability. So I would pay attention to that as you're looking through stuff before you sit down and take the quiz for chapter 15. Make sure you have all that handy. Okay, so drugs are bad. Very good. All right, so actually I have to skip out and go to my doctor's appointment. So I will actually